Hello everyone, welcome to Tesla Daily News. Today is May 27th, Wednesday, and the following is the latest Tesla news. According to recent market data, Tesla stock closed at $433.59, up from the previous close of $426.01, after opening at $430.26 and trading between $426.12 and $435.20, on a volume of about 45,400,000 shares. From a technical perspective, the stock is showing bullish momentum with strong dip buying. For investors, this move suggests renewed confidence after prior consolidation, with buyers stepping in on intraday weakness and pushing the price toward the upper end of the daily range. The relatively tight spread between open and close, combined with elevated volume, can indicate institutional participation rather than just retail speculation. Looking ahead, traders will be watching whether Tesla can hold above the prior resistance zone around the low 430s and potentially challenge the mid 430s and beyond. A sustained close above recent highs could open the door to a short-term breakout attempt, while any sharp reversal on heavier volume would hint at profit-taking. For long-term shareholders, the main takeaway is that the market still rewards Tesla's growth narrative, even amid rising competition and macro uncertainty. According to The Economist, a wave of new battery technologies is emerging that could eventually challenge today's lithium-ion cells, and Tesla is directly involved in that race. The story highlights solid-state batteries, sodium-ion chemistries, and new dry electrode manufacturing processes as key fronts where the next big breakthroughs may appear. For Tesla investors, the most relevant point is that the company is explicitly named as a competitor trying to perfect dry electrode manufacturing, alongside South Korea's LG Energy Solution and others. Dry electrode manufacturing could materially reduce costs and energy use in battery production, while also boosting performance. Trials referenced in the article suggest this method can cut energy consumption by about half and manufacturing costs by around a fifth. If Tesla succeeds in industrializing this approach at scale, its already significant cost advantages in battery packs and energy storage could widen further. That would support margins for both its vehicle business and its stationary storage products such as Megapacks and Powerwalls. The article also notes that global demand for batteries is booming, with electric vehicles expected to reach roughly 30% of global car sales in 2026, and grid-scale battery installations projected to climb sharply by the end of the decade. This structural demand backdrop benefits major battery consumers and integrators like Tesla, even as competition intensifies. However, it also means that legacy lithium-ion technology may face disruption from newer chemistries with better energy density, safety, or cost profiles. For shareholders, this creates a dual reality. On the upside, Tesla's early investments in advanced materials research and partnerships put it in a strong position to adopt or co-develop next-generation chemistries such as solid-state or sodium-ion for certain applications. On the risk side, if a rival firm or country manages a true step-change battery breakthrough first, Tesla could see some erosion of its technology edge. In practical terms, investors should watch for concrete milestones, pilot lines for dry electrode production, any Tesla commentary on solid-state timelines, and evidence of new chemistries entering Tesla's supply chain, particularly for lower-cost models or grid storage. According to the Giesener Anzeiger, Volvo will integrate Tesla's Supercharger network into its official smartphone charging app starting in the autumn, giving drivers of fully electric Volvo models access to more than 20,000 superchargers across 29 European countries. This follows a similar move by Volvo's sister brand Polestar, which enabled app-based use of superchargers earlier this year. While many non-Tesla vehicles can already charge at open supercharger locations, direct integration in the manufacturer's app streamlines the process of search, navigation, and payment. For Tesla investors, this development reinforces a key strategic shift. Tesla is steadily transforming its fast-charging infrastructure from a closed ecosystem into a revenue-generating, semi-open standard used by multiple brands. Each new automaker that plugs into the network increases utilization of existing chargers and opens an additional stream of high-margin services revenue. The more normalized this becomes among European and global carmakers, the more entrenched Tesla's infrastructure moat could be. There are several implications worth considering. First, higher throughput at supercharger sites means faster payback on sunk capital expenses, which can improve Tesla's return on invested capital for its charging business. Second, as OEMs like Volvo do not own similar pan-European networks, they risk becoming dependent on Tesla's infrastructure quality and pricing. That dynamic gives Tesla optionality in how it structures commercial terms in the future, especially as new supercharger generations roll out. Third, Deep integration into third-party apps helps make Tesla's network a de facto piece of public infrastructure, which could support access to subsidies, grants, or public-private partnerships for rural or underserved regions. For long-term shareholders, the network effects of the Supercharger ecosystem may become as important as Tesla's vehicle margins, especially if software and services income tied to charging, routing, and grid services grows into a meaningful share of profits. According to the Frankfurter Neue Presse, a Tesla Cybertruck owner in Texas misused the vehicle's so-called wade mode by attempting to drive the truck through a lake, leading to water ingress, vehicle failure, and a rescue operation. The driver allegedly believed the Cybertruck could essentially function like a boat, despite Tesla's manual limiting wade mode to shallow water crossings of up to about 82 centimeters and only for a short duration. The vehicle, reportedly filled with water, became inoperable and had to be recovered by firefighters, while the driver now faces legal consequences. From an investor's standpoint, this story has several layers. On the surface, it is a single incident driven by clear user error. The driver ignored the manual's limits, misinterpreted marketing narratives, and treated wade mode as a submersible feature rather than a cautious off-road aid. However, such events can still create reputational noise around Tesla's safety and engineering, particularly on social media where images of a Cybertruck half submerged in a lake are likely to be widely shared. The police commentary quoted in the article emphasizes that the ability to technically cross water does not make it legal or safe in all conditions. For Tesla, that message aligns with its own fine print but also underscores a recurring theme. Advanced functions, whether autopilot, off-road modes, or experimental features, are often misunderstood or pushed far beyond their design envelope by a subset of enthusiastic owners. For regulators and critics, this feeds the narrative that Tesla drivers occasionally treat vehicles like experimental gadgets instead of road-legal machines. Will this materially impact the stock? On its own, that is unlikely. Yet for long-term investors, such episodes remind us that Tesla must continue improving user education, in-car warnings, and perhaps software safeguards that limit misuse of modes like wade mode under obviously dangerous conditions. If Tesla can demonstrate a pattern of tightening safety communication and proactive risk mitigation, it can reduce the headline risk associated with extreme owner behavior. Conversely, a string of high-profile incidents could pressure regulators to demand stricter labeling, feature restrictions, or penalties, which could raise compliance costs. According to the NT News, an Australian Tesla Model Y owner describes what he views as a kind of EV insurance scam, noting that his annual comprehensive insurance premium jumped roughly 21% year-over-year, far outpacing both general inflation and the typical rise in car insurance costs. He reports paying nearly 3 times as much to insure his Tesla compared with his previous Subaru SUV, despite being a relatively low-risk driver with low annual mileage. The article frames this as part of a broader pattern in which some EV owners are facing sharply higher or in some cases unavailable insurance coverage. For Tesla investors, rising EV insurance costs are a subtle but meaningful risk factor. Total cost of ownership is a major selling point for EVs. They promise lower fuel expenses and reduced maintenance compared with combustion vehicles. If high insurance premiums erode those savings, some potential buyers could delay or forego EV adoption altogether, especially in price-sensitive markets. That could slow the overall transition to electric vehicles and dampen demand for brands like Tesla, whose products are already perceived as technologically advanced and possibly expensive to repair. There are a few structural reasons insurers might charge more for EVs: limited repair networks, higher parts costs, expensive battery packs, and a learning curve around how frequently these cars are written off versus repaired. At the same time, the Model Y and other Teslas are among the safest vehicles tested in crash ratings, with sophisticated active safety features. Over time, if real-world claims data continues to show lower severe injury rates and certain types of crash reductions, insurers may adjust their models to reflect those benefits. For Tesla as a company, this situation also highlights an opportunity. Tesla already experiments with usage-based insurance in some regions, using driving data from its vehicles to offer dynamic, potentially lower rates to safer drivers. If third-party insurance remains expensive or unstable for EVs, Tesla's in-house insurance businesses could grow into a more important differentiator and profit center, especially in markets where regulators allow telematics-based pricing. Investors should watch for expansion of Tesla insurance into new countries, changes in pricing relative to legacy insurers, and disclosures around its profitability or loss ratios. According to several financial reports, SpaceX is preparing for a future stock market listing, raising the question of whether a SpaceX initial public offering could become a competitive threat to Tesla shares for investors who mainly want exposure to Elon Musk's long-term vision. The argument is that for many years, Tesla has effectively been the only publicly traded vehicle through which retail investors could bet directly on Musk's multi-decade technology and space ambitions. If SpaceX goes public, that concentrated demand might split between the two companies. For Tesla shareholders, the potential SpaceX listing is a double-edged sword. On one side, a SpaceX IPO could reprice the overall Musk ecosystem, drawing in new capital and raising visibility for his broader portfolio of ventures, from rockets and satellite internet to AI and robotics. Some of that enthusiasm could spill over positively to Tesla, especially if investors view these companies as complementary aspects of a unified technological future. On the other side, certain investors who currently hold Tesla primarily as a bet on Elon Musk himself might shift part of their capital directly into SpaceX, particularly if that company's growth profile or margins appear more attractive. If this reallocation happens at scale, it could generate incremental selling pressure in Tesla shares, especially around the time of any major SpaceX liquidity event. Additionally, analysts might begin comparing the two companies' valuations more explicitly, which could reset expectations for Tesla's long-term multiple. In strategic terms, however, Tesla and SpaceX operate in largely distinct markets: terrestrial transportation and energy for Tesla, versus aerospace and satellite communications for SpaceX. There are technological overlaps, such as materials, manufacturing processes, and AI, but limited direct business competition. For long-term investors, the key is to evaluate Tesla's fundamentals on their own merits: vehicle volumes, software and energy revenues, margins, and innovation pipeline, rather than assuming its fate is tethered to SpaceX's market debut. Still, monitoring investor sentiment around a prospective SpaceX listing will be important, as it could temporarily increase volatility in Tesla's stock around major SpaceX milestones. According to Business Standard and other automotive outlets, Ferrari has unveiled the Luce, its first fully electric vehicle, entering the high-performance EV segment dominated in volume terms by Tesla but in prestige terms by brands like Porsche and Rimac. The Luce is a hyper-luxury, 4-door, 5-seat EV developed with Johnny Ive's design collective Love From, priced at more than €500,000 and powered by 4 independent electric motors with over 1,000 horsepower. With a claimed top speed around 310 km per hour, a range of more than 500 km, and a heavily design-centric cabin, the Luce targets ultra-wealthy families and tech-savvy buyers. From a Tesla perspective, Ferrari's move is less about direct volume competition and more about the broad legitimization of EVs as the future, even for the most tradition-bound performance brands. When Ferrari, one of the last major holdouts of pure internal combustion passion, commits to a flagship electric model, it signals that electrification has crossed a psychological point of no return in the high-end market. Tesla's early bet on EVs now looks even more prescient as competitors reposition around similar core technologies. In terms of direct rivalry, the Luce will not compete with mass-market Teslas on price or scale. Instead, it joins a small club of halo EVs that includes the Tesla Model S Plaid, the Porsche Taycan Turbo GT, the Rimac Nevera, and a few others. These vehicles shape brand perception and help define what is aspirational in an electric era. Tesla benefits indirectly when EVs become synonymous with ultimate performance and desirability, but the company must also keep pushing innovation to maintain its leadership in acceleration, handling, range, and software. Ferrari's decision to retain physical controls, emphasize sound design that amplifies natural electric motor frequencies, and create a more traditional, tactile cabin contrasts sharply with Tesla's minimalist, screen-centric approach. That underscores a key competitive axis: user interface philosophy. Over time, we may see a clearer segmentation where some buyers gravitate to Tesla's software-first ecosystem, while others seek the bespoke craftsmanship of brands like Ferrari. For investors, the bigger picture is that the EV performance space is becoming crowded at the top, but Tesla still holds a strong advantage in cost structure, charging network, and in-house software. The real question is how effectively Tesla can bring the next generation of high-performance technology, battery improvements, motor efficiency, and AI-assisted driving to more affordable segments where most global volume will reside. According to HEG in Hungary, the aftermarket tuning firm Unplugged Performance has launched an expedition package for the Tesla Cybertruck, aiming to make the vehicle even more off-road oriented and visually aggressive. The package, priced at about $18,500, includes more rugged bumpers, new LED lighting, and underbody protection, among other enhancements. While this is a niche offering, it highlights the emergence of a secondary ecosystem around the Cybertruck specifically, similar to the long-standing aftermarket scenes for pickup trucks from legacy manufacturers. For Tesla investors, a thriving aftermarket universe is often a good sign. It suggests strong brand passion and an installed base willing to spend additional capital to customize and upgrade their vehicles. That can indirectly support Tesla's pricing power on accessories and possibly inspire official off-road or adventure-oriented trims in the future. It also supports the narrative of Cybertruck as not merely a novelty, but as a platform for specialized use cases such as overlanding, expedition travel, and utility work. However, the presence of third-party off-road packages also puts more real-world stress on Tesla's engineering. As Cybertrucks are modified for harsher environments, their performance and durability in extreme conditions will be tested and widely shared online. Positive results would reinforce the truck's rugged image, while frequent failures could trigger warranty headaches or reputational harm. Investors should therefore watch reliability data, off-road media reviews, and any changes Tesla makes in response to sustained off-highway usage. These stories together paint a picture of Tesla at an interesting crossroads. The stock is showing renewed strength. Advanced battery technologies are maturing with Tesla in the race, the Supercharger network is becoming a multi-brand utility, and competition in both the high-performance and mass-market EV segments is accelerating. At the same time, secondary issues like insurance affordability, user misbehavior with advanced features, and the capital markets impact of a potential SpaceX IPO add complexity to the investment thesis. As always, staying focused on fundamentals, technology, costs, scale, and execution will be key for anyone following Tesla closely. Thank you for listening to Tesla Daily News. If you enjoyed this episode, please subscribe and stay tuned for our next update.